Good day, traders. Jeffrey Friedman, Senior Commodity Broker, RJO Futures, here coming to you from the CME trading floor with my comments on stock index futures. Well, the word of the day or the week of the day is the FOMC, Ben Bernanke, the Federal Reserve. Are they going to pull away QE from the marketplace and keep them from starving, if you will? We're in a huge bull market, 5-year bull market. We're up 14 to 16% for the year. Every time I've been here, I've been telling you, in my opinion, you got to go with the flow, you got to buy the market. Well, lately, there's been hints that they might be taking away QE3, along with China having a weak manufacturer index. And of course, if they bring QE from coming to the table anymore, $85 billion worth of bond buying or mortgage-backed security buying, what would that do to earnings, corporate America, and stock index futures? Well, we saw a taste of it being up so much where the market did pull back. We had a big outside day when they did do that announcement. And the outside day means that we made a higher high, and actually in a 5-year period, we made contract highs for the S&P futures and the Dow Jones futures for the year, and then close underneath the previous day's low and then close lower, which is a minor sell signal with a follow through and a lower close the following day. A lot of the bears are cheering, if you will. So that's what's on the docket fundamentally and technically. Now, some of the numbers I'm looking at, the S&P, we need to close under 1620. We did get a 1630, 1632-ish area, and then a bounce off of that. We need a close in the Dow Jones June futures to be, I would say 15,000 even, not 15,200. And in the in the NASDAQ, I would think 2,900. We need closes under those levels 2 days in a row for the bears to really get on the table and start screaming, hey, we're in the middle of a pullback of 5-7%. Being up 16 or 14%, we can afford to pull back 6, 7, 8% and still be in a bull market, but that's where they would take control of the marketplace. So for right now, I'm still thinking, in my opinion, that we're buying dips. We don't know exactly the timetable for pulling QE. People are starting to get the idea that they will kind of pull it off the table in the next 6 to 12 months. We don't know exactly when. There's a big debate among voting members of the FOMC. My target in the S&P future June contract would be on the upside, maybe 1690 would be a nice level of a target for the bulls. So if you can buy it around the 1630-ish level, with always using stops, in my opinion, that would probably work for the bulls. If you're bullish, if you're bearish, then you look for a resistance level. Any significant talk on exactly when or yes, we're going to pull it away, the QE, FOMC pulling away some of their free money or cheap money, bond buying, if you will, keeping interest rates very low, that, in my opinion, will have a short-term negative effect for the stock index futures. Any reports out of Europe or China saying that their economy is running weaker than we thought, that would be possibly a negative. Looking at Japan in relationship to the stock index futures, obviously looking at their currency, looking at their purchasing or QE, if you will, their stimulus for they've taken their currency from 129 or 130 down under par to the dollar index. I got to say that that's a carry trade. When you see their bonds, the Japanese bond interest rates starting to rise, that would be a negative. That means the carry trade is kind of off. Remember, always trading futures or Option to futures involves risk of loss and not suitable for all investors. Remember, contact me, Jeffrey Friedman, RJO Futures, here in Chicago, and I'll help you with anything that you need help with. Good luck and good trading.